Hi, it's Steve here from Snap Projections to provide an overview of our new taxable income targeting tool. I'm going to be using a demo scenario for John and Jane Snapper. We can see that they're currently 58 years old, looking to retire in 2 years' time at 60 with a target spending of $150,000 net. This is being funded through a combination of a defined benefit pension plan, government benefits including CPP and OAS, as well as withdrawals out of their financial assets. So we have non-reg withdrawals, TFSA withdrawals, lift payments, and then eventually at age 72, RIF minimums coming out in order to fund their desired spending. We can see at the end of the plan that there is projected to be a small surplus remaining. As we review the taxable income section, we can see that they have fairly minimal household taxable income for the first 5 years of retirement before their government benefits kick in. Then it increases slightly until age 72, and then it spikes at age 72 due to the RIF minimums. If I look at John's page individually, we can see more information, including any marginal and effective tax rates. So we have a marginal rate of 19% to start, increasing to 31.48 once the RIF minimums start. We can also see some OAS clawback resulting from that higher taxable income. In order to set a target taxable income in the software, we do have a new tool available. We can enable that from here. And before I do that, I'm just going to copy my base scenario so that we can compare our taxable income targeted scenario to the original and see whether that has helped the client's situation improve. So now I've created scenario 2. I'm just going to update the title. So we'll call this scenario 2 taxable income target of $52,886. I'm going to turn on the feature from the taxable income column on the planning page by clicking on the gear symbol and then checking the box to enable this new feature. By default, I'm going to start at age of retirement so that we can set a target for their decumulation period. You can use this for the accumulation period as well, but in most cases, we'll be using that throughout retirement. So I'll click Save. And that's going to add a new column to the planning page in the taxable income section. We'll be able to see both the actual taxable income that's being realized and then the target that's been set. When you initially turn the feature on, Snap pre-populates the target with the original actual taxable income so that the plan doesn't change as a result of adding the feature. Then what you're able to do is click on the first year and change the dollar value that you want the client to target. And you can use marginal tax rate brackets, OAS clawback threshold, or different values that you feel would be appropriate given the client's situation. In this case, I'm going to start with a target of $52,886, which is the top of the lowest tax bracket in Ontario. I'm going to copy that over to Jane as well so that they each have that individual target. I'm going to copy that down to age 100, and I'm going to enter that as a real dollar value. So that means that Snap is going to index this figure forward to each year of the plan in the future. And that's used because Snap assumes that marginal tax brackets increase with inflation. And so the 52,886 today, once we click the blue check mark, is going to be indexed to 55,131 in the first year of retirement. So now that I've entered in my target, I'll go up to the top and click Run Scenario. And then Snap is going to recalculate the plan, and it will attempt to get as close to the target as possible with the actual column. So you'll see now that the actual values are aligned as much as possible to the target that we've set. And that's allowing them to get more taxable income out at this 19.05% threshold. And that's resulting in less taxable income being realized later on in the plan at the 31.48% rate. We've also reduced the OAS clawback slightly by taking out more money early in the plan and leaving less to be paid out in the RIF minimums. If I scroll to the right, we can see how Snap is achieving the increased target. So in this case, Snap is taking extra money out of the registered accounts until the government benefits start, and then it's wrapping those withdrawals around the client's other taxable income sources. So that's if we wanted to use the top of the lowest tax bracket. We could try copying this scenario and running a different threshold just to see whether we can get rid of more of that OAS clawback that's currently being modeled. So in this case, I'm going to do a taxable target of $57,300 375, and that's just the top of the second bracket. So I'll go to John. And remember that all of these values that I'm referencing are in today's dollars. So when I check the in real dollars box, it's going to index that for me over time. So it'll be 59,810 in the first year of retirement. And so with that increased target, we can see that Snap is now taking a bit more out of the registered accounts early, and we've almost gotten rid of all of the OAS clawback that's projected in this case. So I'm going to do one more just to see whether we can get rid of all of that OAS clawback by taking out a bit more in the early period of the plan. So we'll copy that, rename to scenario 4 with a target of 70,000. So we'll copy to Jane, copy down to 100, and set that in real dollars. And then we'll run this scenario. And so once again, we can see that Snap has adjusted the registered withdrawals in order to work towards those higher taxable income levels. And we've now gotten rid of the OAS clawback entirely. So you'll see there's no longer a column to the right of OAS. We're now expected to receive the full OAS benefit by smoothing out the taxable income over time. You'll also see that we're now capped out at 29.65%. And so we don't jump up into that 30% rate that we saw earlier. So now in order to decide which of these targets is optimal for the client, we can go to the menu option at the top and then click Compare Scenario. We'll select all 4 of the plans. And there's a few metrics available that we can use in order to try and figure out the best option. So you'll see from the base scenario, we had that slight overfunded status. We had 104% of what we were projected to need. We increased that to 105% with the first target, and that stayed relatively the same with the second target, and then it actually dropped when we increased to 70K. So this would suggest that the increase to 70K is not optimal on a longevity basis. We can see how much the client is paying in personal taxes across each of the scenarios. So we dropped by about 100,000, then we dropped by a further 20,000, and then we actually increased by about 6,000 by increasing the target to 70,000. And OAS clawback, we started off with about 61,000, and then we were able to all but eliminate it in the final scenario. If we look at the personal estate after tax, we can see that we increased it initially, then increased it again, and then dropped it a bit in the fourth scenario. But these are summary values and points in time. So another option is we can review the trends in order to see how the different scenarios compare for each and every year of the projection. We can then look at a chart, for instance, of the estate after tax in order to see which projection is optimal in each year of the plan. So if we look at the base scenario, we can see that it has a low taxable or a low estate after tax for each year of the projection. We increased it in each and every year of the plan by setting a taxable income target. And what this has done is it's taken out more registered money early in the plan. So if they pass away early, their estate will have less taxable income realized at the highest bracket, and therefore they or their beneficiaries would be better off. But if they keep living long into the future, because they've taken out more money at those lower tax brackets, they're better off in this case by having smoothed out their taxable income and realized a lower effective tax rate overall. When we then move to scenario 3 and move up to the top of the second tax bracket, we can see that that's improved every year even further than scenario 2. And then we start to get into trade-offs. So with scenario 4, we can see it's better for about the first 40 years, but then it's worse for the last 10 years. So ultimately, we would likely want to decide between scenario 3 and 4 for which one to recommend to the client. In this case, the majority of the years are better off with scenario 4, so we might target that one as our recommendation, given that their life expectancy might be somewhere around this period. So that's how you can set a target in Snap and how you can compare different scenarios in order to see which one is optimal for your client's situation. A few important notes about the tool. If there is surplus cash flow generated from the RSP, that will be allocated into the client's non-reg or TFSA assets. So if you don't have a TFSA or non-reg, SNAP may not be able to reach the target if it needs to take extra money out that is not required for the plan. As an example, if I set a target of 150,000, SNAP is going to take out extra money from the RSP and it's going to deposit anything that is not required for spending into the client's financial assets. So you'll want to ensure that you have a TFSA and or a non-registered account in your plan in order to ensure that SNAP has everything that it needs to fully use this feature. Other things to consider when using the taxable income targeting is that SNAP will first use the client's resources. So John will try to meet his own target through taking out withdrawals from his account, and then it will move on and use pension income splitting if needed in order to split income from one spouse to the other. So it does still factor in pension income splitting, but the first thing that it will try and do is use the client's own resources in order to reach that target. SNAP allows you to still override accounts, so you can still set the TFSA to 0 in a year if you don't want contributions going in there. So you still have final control and say over the projection, which is a great combination of automation with the transparency and customizability that you're used to in SNAP. So you can still tweak things as needed, but ultimately SNAP will be able to do the majority of the heavy lifting in terms of the decumulation process. Thanks so much for joining us, and I hope you have a great day.